Good morning. This is the IRS Solution Attorney, Darrin Mish.
And I'm your co-host, Katrina Madewell. Welcome to the show.
The topic of today's show is what do I do when I have a tax lien and I want to sell my house? And so I thought that would be a really cool topic for today.
You thought I would have fun with that one.
Since I sit right next to real estate agent extraordinaire,
Ooh.
Katrina Madewell.
Oh, that's a compliment from you. Thank you.
So what do you know about this topic?
Oh, where do you want to start? Let's see. If you have a tax lien, you're not going to be selling your house without paying that tax lien. How's that?
Yeah, so let's talk real quick about what a tax lien is, just real briefly. So,
Or buying a house.
Yeah, it's going to make it challenging to do either. So a tax lien is what happens when the IRS, when you owe the IRS money, and the IRS has finally kind of had it with you, they go ahead and file something called a tax lien, a federal tax lien. Typically in Florida, it would be in the clerk's office for the county that you live in, where the official records are filed, so where the deeds and mortgages and that kind of thing, judgments are filed. They'll file a lien against you, and typically it's going to prevent you from conveying, buying or selling real property because without it being satisfied in some way. So in a lot of ways, it's similar to a judgment, don't you think?
Yeah, they're going to find it. I mean, people often ask, they wonder, like, why do I have to give my social security number and stuff like that to title? Well, that's why. Title is checking. If you have any liens or judgments or tax, anything like this, and it comes up, they want to make sure it's you and not someone with a similar name.
Yeah, for
Which
sure.
happens.
I mean, and there's social security numbers on the federal tax liens. They used to be out in the clear, and now they're redacted at least so that people can't, people
Thank goodness.
in Asia can't just mine that data over the internet and steal your identity. But yeah, those liens are filed there to keep, basically to what's the word I'm thinking of? To protect the IRS's interest. So if you had a $100,000 tax lien, for example, and you're selling a house that's, you own free and clear and it's worth $200,000, the lien is there to make sure that they get paid.
Well, they have to put the world on notice. That's what they would tell you if you were taking a title course.
Absolutely.
Probably similar in law school, right?
Absolutely.
Putting the world on
It
notice.
puts the world on notice that there is this unresolved,
money.
yeah, there's this unresolved liability that they have a claim against, and they want you to take care of it.
The other thing too that we've seen is they a lot of times can file a lis pendens, which means something's going on with the property. It's not always foreclosure.
Yeah, I've never seen the IRS file a lis pendens. Although a lot of times people are really afraid that the IRS is going to, if they have a lien, that they're going to seize their primary residence. And we've talked about this quite a bit on the show, and that's really rare.
Well, they probably have to file that lis pendens in order to seize it.
I don't think so. I don't think so, because I have seen a few of these. It's never happened to one of my clients because I've never taken the case. If somebody's called me at this point, and so in other words, if I've been representing the client, they've never had their primary residence seized. I've had some people over the years call me when that seizure process has already been instituted and ongoing, and I just bow out because it's kind of too late at that point. What the IRS has to do in that case, if they do want to seize your primary residence, is they have to go to it has to go through management all the way up the chain, and then they file a lawsuit in district court, and a district court judge has to approve the seizure of that primary residence.
Right. But in Florida, it would be rare, especially if you have homestead exemption on that property. It would be rare.
I don't think it matters because of the supremacy clause, so that the homestead exemption doesn't, because it's a state law creation, does not apply to the feds.
Well, that would make
So
sense.
everyone else, for sure, everyone else, it does apply, but the feds,
It's going to trump anything state.
yeah, they come out on top.
They
So
created.
my experience shows that the IRS is not typically interested in seizing a primary residence unless there's been extreme abuse going on. Now, this is not my typical case where somebody hasn't filed tax returns in 10 years and owes, $200 grand. That's not the extreme abuse I'm talking about here. What I'm talking
Wouldn't it
about
be like
is
embezzlement, money laundering, that sort of stuff? Like you bought your house with drug money, that sort of stuff?
yeah, I mean, that would be a pretty rare fact pattern too, but I could see that happening. But it's typically like a tax protester who has really poked their finger in the eye of the IRS for years and years, and they have assets. So I saw one time where there was a family farm. It was a couple hundred acres. I think it was in Polk County, and they were tax protesters, and I think the land was paid for. It's really valuable, and they just kept poking the IRS and poking the IRS, and finally somebody at the IRS decided, okay, I guess I'm going to do the work,
You're going to get it.
and they just lowered the boom on them.
So let me ask you this, just playing devil's advocate, if that was the scenario, why wouldn't they just put the property, say, in a trust or in someone else's name I mean, why wouldn't they do that? Wouldn't that sort
Well,
of...
you can't do that after the fact.
No, not after the fact, but I mean, if you're a tax protester and you have assets, especially free and clear assets,
Well,
why would you not?
they probably bought the house, 50 years ago, and they started engaging in the tax protester activity, 20 years ago, and then, and so
I guess that
they didn't
makes
get
sense.
around to it. And even if they had, the IRS is going to go ahead and pierce all of those trusts and nominee situations. And I'm not saying that that's right or proper or legal or anything, but that's what the IRS is going to do. And then they're going to put the taxpayer on their heels, and the taxpayer is going to have to fight to get that undone. Does that make sense?
Yeah.
And so the taxpayer is going to be fighting the might and the money of the United States government. And I don't know anybody that has the money to do that.
No,
I don't think Warren Buffett could fight the
You'd
U.S.
have to
government
be
if the U.S. government really decided that
You'd
they were
have to
going
be
to
a
fight.
crazy attorney that wants to work for free. They would do it.
I resemble one of those remarks, but not both. So
Come on now, honestly, like you either would have to pay an attorney out the wazoo to do that, or be an attorney and represent yourself, which,
I can't
how
tell-
smart that would be.
I can't tell you how many times I've been offered the case of, let's go, I want you, Mish, to go and fight and prove that income taxes are illegal, and we can go all the way to the Supreme Court. And it's like,
He's
but there's
a
no,
lo- he's a
there's no,
lover, not a fighter.
well, there's no financial, obligation or incentive behind that, because
Right.
they don't want to pay me, they just want me to do it. Well, that would take the rest of my life.
Yeah, and who would want to do that anyway?
Well, I think it's kind of a cool idea.
Maybe when you're retiring.
If I could get paid to do it, I try to do it. But if the offer is, hey, you can go fight for the rest of your life and not be able to support your family, I think I'm going to pass on that opportunity.
So I imagine there are times where, people have been la-ti-da this whole time, have these tax liens kind of hanging out there, and now they're in a position where they need or really want to sell, and they have discovered that this tax lien is going to hinder the sale.
Happens all the time.
Which, from a real estate contract standpoint, we'll talk about that in a minute.
And when we come back, we can talk about some of the nitty gritty about what do you actually do if you want to sell your house and you have a tax lien. There's a few options. Some of them are good, some of them aren't that great.
Yeah.
And it's all really fact specific.
Well, we'll talk about too, like what happens if you're already under contract. Like if you listed your property and you're under contract, the buyer says, "Yep, I want to buy your property for $500,000," and you got this cute little $250,000 tax lien. Yeah, that'll be fun.
Could be a problem.
All right, if you want to call in, you've got a question, we're live in the studio today at 888-404-1010, 888-404-1010. And Darrin's off-air number, if you want to talk to him directly about your tax problem and not do it on the air, is 888-GET-MISH
888-438-6474.
or getirshelp.com. We'll be back in just a minute.
So we were talking about in the last segment about, okay, so we get down to brass tacks, your house is under contract.
You got two contracts at that point.
Yeah,
You got a contract with your listing broker, and you got a contract with the buyer to buy it.
So what have you seen in that situation?
Well, if they haven't figured that out in advance of that point, guess what? It's still a legal binding contract to the buyer.
Ouch.
The
yeah.
fact that they
Yeah,
can't,
you're right.
the fact that they have a lien that could change their net or make them write a check has no bearing on the sale.
And so one of the things we learn in law school in like the first semester or the first year is, land is unique. All land is unique. And so it's one of the few times when you can sue for something called specific performance in
Oh,
a
yeah.
contract. So in other words, most of the time the law doesn't really care who is the breaching party in the contract. You just measure damages based upon how much money, it costs the non-breaching party. So, but real estate contracts are different. So what Katrina is saying here is if you have a tax lien and you were under contract to sell that property, and you then later decide or determine that it's not financially advantageous to you to sell, then the buyer could actually sue you at that point for specific performance and force you to do that. And I can tell you that if I was in that situation as a buyer, and I'm a pretty nice guy, I'm really not a litigious guy at all, if I had my heart set on that deal on that house, I would sue for specific performance at that point.
Plus you have money tied up into it. You paid for inspections and appraisal, lost time. You might have missed another property that you could have made an offer on because you were tied up with this one.
Yeah, and the whole point is not so much the inspections and all that stuff. Maybe that's $5,000 or $7,000.
Well, we
It's
don't
not really about
see
that.
a whole lot of specific performance, and I think that's because it determines the dollar amount. So there were times, like for example, my brother-in-law, when he bought a property back when, you know, the market was going crazy and the waterfront was a big thing, you know, he bought a property on the Cody River, and the seller actually got another offer, a higher offer from someone else. Well, that point, it's binding. You can't just say, oh, I want to take this offer. So he, in fact, threatened the seller for, you know, for failure to perform. And, you know, all the real estate contracts pretty much that we use as agents are going to have arbitration and mediation clauses built in there, which means you have to do mediation and arbitration before you could sue somebody. But nonetheless, they could still be sued for failure to perform.
And you're going to win an arbitration in that case anyway. So
Right.
it's, I mean, it's not a really big deal. It's probably good at that point because arbitration is going to be faster, cheaper, you know, and if it's binding, then it's going to be binding on the seller in that case too.
And so here's the thing. If you think that you might have a tax lien, or if you have this thing where you have not paid taxes, or you have something, I mean, you know if you owe taxes, if you're going to enter into a binding contract, simply add in a third-party approval addendum. So this can be added into your listing contract or to your buyer contract. Now, in the past, this was brought into play because of short sales, right? So they're going under contract and they technically can't sell it until they get this third-party approval, meaning their bank has to agree to sell it for that lesser amount. The same could hold true, and that same provision would also work in this particular instance.
Okay, that's good advice. So let's talk about let's talk about the general rule if you have a tax lien and then some exceptions to that rule. So we kind of went over in the first segment. The general rule is that the federal tax lien has to be paid off first before you can actually sell your house. So in the context of what we're talking about is, you know, you have a $500,000 house, let's say it's free and clear, and you have a $250,000 tax lien. The first $250,000 is going to the IRS to pay off the tax lien. Now there are some exceptions to that rule.
So do you have customers that come to you and they're in this instance?
I have over the years for sure had people that were, you know, not so.
Maybe they want to negotiate that number a little lower?
I've had a few that were under contract, but usually it's more like I want to sell, and I've been advised that I can't until I get this resolved. So let's talk about some of the options or some of the alternatives.
That's actually good advice. It's way better than being under contract trying to do it.
Yeah, way. So the first thing would be, you know, one of the things we talk about on the show all the time, which is to do an offer and compromise. You know, if you have an offer and compromise accepted and paid, then the IRS has 30 days after the payment of the offer to release the federal tax lien, and it works really well. Now here's the problem with an offer and compromise. They take a long time. People think, oh, this is going to take like a week. No, not at all. It's going to probably take longer than a week to prepare the package, and then it's going to take somewhere, I can tell you from my personal experience, from 6 months on the short end for a super easy offer where you're obviously broke and have no assets and you're a W-2 wage earner, all the way to about 18 months if it's a more complicated case. Now, incidentally, the IRS only has 2 years from the submission of the offer to rule upon the offer. So if it just gets lost for 2 years, then you win, which is great. But I've never seen it happen, and I'm plugged into thousands of guys that do what I do, and no one's ever seen it happen. So
let's think about this for a minute.
Good for them. They're not blowing the dates.
You want to sell your house. Like, usually that's, when you decide to sell your house, you're kind of ready. Like, there's some people that will take a little more time to plan and prepare over a period, but I haven't seen anybody really that calls like more than a year out. Now, there are people that have been in their home for a long time and they're like, hey, I need to figure out where to start. I've been here for 30 years. I got a lot of stuff. But it's not 2 years.
Even more common in my case is that the homeowner taxpayer is having, you know, financial problems, and so they need to sell, or they need to do a short sale, or they need, you know, because they're facing foreclosure or whatever, and they want me to take care of the tax problem. Now, sometimes I can and sometimes I can't. It just depends on the facts and you know, the specifics of what's going on. So let's talk about the second exception, and this is one
if they're doing a short sale, that might actually be a good thing.
Like
if you're working on the case, and because the bank, they're going to allow that. That's going to be what they consider an allowable expense when they're looking at short sales. So they're not going to say, oh, this is just some buffer expense on the settlement statement. They're going to say, no, this is legit. If it's a tax lien that's going to attach to the property.
Yeah, we're going to talk about what's called a certificate of discharge from federal tax lien a little bit later in the show, and that would be what would happen if you were doing a short sale. Is the IRS has to get involved in the deal. They have to look at the closing documents, and they have to sign off, basically bless the fact that they're not going to get any money from this sale.
But what I'm saying is, if you have to pay them, it might be a good time to settle that.
Well, you're never going to have to pay them, because the first mortgagor is always going to be in first place above the tax lien, because Not always, but I mean 99.9% of the time, the first mortgagor is going to be in the first position, and the tax lien is going to be in second position because, I mean, it's a purchase money mortgage.
I don't know.
I've seen,
According to the lien line, from my recollection, when I did real estate and title school, which was a long time ago, tax liens are superior to mortgage liens.
not a purchase money mortgage, and we're in what's called a race state here in Florida, which means basically the basic rule is whatever encumbrance is filed first is first in play, first in line. And so you're probably thinking of property tax liens actually are superior to
Yeah, that must be it.
everything. It's inferior to a property tax lien, but a federal tax lien is basically just whenever it was filed, it's in Florida. Now, if you're listening in a different state, do not take this advice because not all states are
Right.
race. Race just means it's a race to the clerks to get the thing filed, but most states aren't. So the next thing we're going to talk about, and this came up in a case that I worked with you, Katrina, is the statute of limitations. So the statute of limitations is 10 years from the assessment of the tax. Basically what this means in layman's terms is 10 years from the date the IRS declares that you owe the tax, 10 years in a day, it expires and you no longer owe the money. And that's actually going to be the topic of our IRS Trainer of the Week today, is a case where that happened. So
And that sweet little couple, I still remember them, and I remember her, like, after we told her that this was settled and it was done and it was all taken care of, she was gonna get to buy the house, she was just like, oh, thank you, Jesus. She was like, I thought I was gonna have to divorce him. It was so cute.
yeah, it's one of the great things about what I get to do for a living is it's just such an insurmountable problem to people, at least because they don't know what's going on. They don't do this for a living, and it is complicated if you don't do it for a living. I was talking to a really good friend of mine yesterday, and a non-filer, and for a long time, 10, 15 years, and he just completely spun out about it. Like he can't hardly even function in life because he's so worried and scared about this situation. And so what I did for him is what I do for most people is I just chunked it down. It's like, okay, let's not try to eat this elephant all at once. We're just going to chunk it down, and we're going to do this, this, and this.
Find a starting point.
And then when you do those things, we're going to reconvene, and I'm going to give you the next things to do. And none of these things will be terribly difficult if we just do them all in a row.
It's just making a couple little steps at a time.
And that's the thing you have to do. And that's a good advice for any problem that you have in your life is you just have to figure out a strategy, chunk it down, and go at it.
So Darrin, is that all tax liens after 10 years? Statute of limitations is up, or is there differentiation between different liens?
Well, there can be things for federal tax liens. That is the rule for all federal tax liens, okay? They have 10 years. But there can be things that stop that 10 years from running and extend that time. And so the IRS has an opportunity to refile that tax lien if that happens.
How often does that actually happen?
Quite a bit.
Ah, so they're restarting your 10-year clock is what you're saying?
They don't restart the 10-year clock. They just add. If it was told for a year, they add a year.
Ah, all right. Well, you're listening to the IRS Solution Attorney Show. Today's show is all about what to do if you have a tax lien and you want to sell your house. We'll be back in just a minute.
Welcome back to the IRS Solution Attorney Show. I'm the IRS Solution Attorney, Darrin Mish.
Yuppers, he is. I'm your co-host, Katrina Madewell. Welcome back.
The self-declared IRS Solution Attorney. But that is, in fact, what I do all day is I provide solutions to people who have problems with the IRS.
And I am not an attorney, thank God. I am just a sidekick to the show.
And she definitely did not stay at the Holiday Inn Express last night.
Where did that come from?
Okay, so we got to get through the meat of this here because I know that there are people that listening that do actually want to hear what we have to talk, the topic.
Get to it.
So let's get down, okay? So we're talking about the statute of limitations there a minute ago. And we talked about the fact that the statute of limitations can be stopped. The technical term is called tolled. So the statute can be tolled while some things are going on. For example, if you file an offer in compromise and it takes a year and a half and it's rejected, that statute's going to be tolled for the year and a half plus, I can't remember if it's 60 days or 6 months, but it's going to be tolled for that time frame.
So a good equal word would be paused, right?
Yeah, it's going to be paused and a little bit more time is going to be added on for administrative delay and stuff like that. And so if sometimes what happens is there's a column on the tax lien that says last day for refiling. So if you're looking at a tax lien and you see the last day for refiling date, then if the lien's not filed within 30 days, refiled within 30 days of that last day for refiling, then the lien is actually technically released by law. Okay, so you could have a situation where the lien expires the lien expires before the obligation expires, just because the IRS wasn't with the program and didn't refile the lien. And so that happens sometimes. And so that's going to be an example of where you're going to want a professional to come in, step in, figure out if the lien is releasable without paying it, because that would be way better than paying it, right? Almost
Yeah.
in every case. In fact, your case, the amount of controversy was pretty small. And then there's sometimes
I don't remember
when
how much at this point.
So the
it was a
liens-
big deal to them.
the liens are self-releasing on their face after those dates that I was just talking about. What does that mean? It means that technically the lien is self-released after that date has elapsed, okay?
Now, why does the IRS do that?
But nobody follows that. Nobody. The IRS does, but they're the only ones. So your title company isn't
Right.
isn't going to be down with that. Nobody's going to be down with that. So what happens is you have to ask the IRS to release the lien. And 9 times out of 10 they will do it. Lately they've been playing games with us. They want the taxpayer to pay the $6 filing fee or recording fee, whatever. We've
What?
been having problems with them. But 9 times out of 10.
Oh, they sent ours back and told us to record them. Remember that?
Yep. In your case, and that was Orange County
With a
too, which is
letter,
weird. Yeah.
with a letter that said, by the way, include this letter so that they know it's really a release from us, kind of thing.
Yeah,
Really? That's what it said.
You did, and if you think about it, it's a
I thought it was
monumental
cool.
task to know all of the recording procedures for every county in the United States. So anyway, the IRS will often.
But I mean, think about that. I wonder how many people just try to generate this piece of paper that looks like a tax lien release and file it. Anybody can file anything.
Yeah,
at the clerk's office.
I had a client about a year ago that had a release, just like in your case, and it was in Pasco County. And he goes up to Pasco County in Newport Richey, and he tries to file record the piece of paper, the release,
Oh,
and they're like, "Beat it, buddy." And so.
See, that's what I mean.
and he was not a real sophisticated guy, and so he didn't really know what to do, and so,
So they don't wanna
we got
pay?
it. We ultimately got it done, but
They don't want to pay the $6 to release it, so they send it to you to actually go record it. And you go to the clerk's office to record it, and they're like, I don't think so.
classic government not talking to each other, right? So one is state and one is federal, and so that's what
So
happens.
that was probably a mess behind the scenes of the IRS, which is likely why they put that letter in there, remember?
Yeah, and they're inconsistent about including that letter too.
Oh, that's
so
fine.
sometimes it's there, sometimes it's not. So let's talk about a couple other little things before we run out of time entirely in the show today. Sometimes you'll have a case where, like I said, the lien is just expired and hasn't been refiled, so that would be good. You can get a release there. Sometimes you'll see the lien and it'll be so old that we know that not only has the lien expired, but the underlying obligation has expired too, which is the case that you had. And then let's talk about, well, what happens if you just want to refinance your home? What do you do then?
Well,
So-
you're going into lien subordination, but good luck with that.
Well, I've done a number of them. They're not super easy, but
They allow lien subordination?
they do in fact allow lien subordination. There's a whole process for it.
I don't know that your lender would allow that, but
I've done a few with
They
our
have?
mutual friend. I think I've done at least one with our mutual friend. I think that does mortgages.
yeah. The
Pretty sure
Sarah
we have.
Cricky with the mortgage firm, she's one of our show partners.
In fact, she just interrupted the show by calling.
She
It
did, that was her
brilliant. It was
chiming in the
wonderful.
background.
And
If she was watching or listening, she could actually be calling in, chiming in on this subject.
so a lien subordination is basically a situation where you want to refi your house. So let's say you're not going to pull money out, but you want to change a rate or term. Typically, is what happens. Okay, so let's say you owe $100,000 on your house. You owe
You got 7% and you want to go to 4.
yeah, and you owe 50 grand to the IRS, and exactly you're at 7% or 9%. You want to go to 4, or you want to go from a 30-year to a 15-year or a 10-year. Then there is a way to do that. You're going to go ahead and apply for lien subordination from the IRS. The IRS is once again going to inject themselves into your deal. They're going to verify that you're not getting any money out and that everything's above board. There's no inappropriate expenses being paid. Funny story, the very first one of these I did years ago, it was about 18 years ago, and the deal was going down in Nashville, Tennessee on top of it, just to make things more interesting. The client, I didn't know any better, the client was going to pay me out of the closing. And so I went along with that.
They
Shouldn't
probably
have.
said,
but- And I think my fee was, it was in the thousands. And I had 40, 50, 60 hours in this deal to make sure that it happened. And when the IRS got down to brass tacks, they allowed me $500 as my fee. So learned a lesson.
Yeah,
Don't do
you
that.
did.
So,
Pay for your education one way or another, don't you?
yeah, it's either, the easy way or the hard way, and that was the hard way.
So subordination, like going back to that, because that's kind of a weird word, right?
Mhm.
Like it's a jargon word for sure in the real estate industry, but it's not one that most people would actually use. So going back to that lien line, what you're talking about is if you have that first mortgage, then you got that tax lien hanging out right behind it. If you pay off that first mortgage by way of refi,
First mortgage was in number 1 position, federal tax lien was in number 2 position, and then if you were going to get rid of first mortgage in one position by repaying, by paying it off in the refi, then you'd have federal tax lien and then you'd have the refi loan, and nobody's ever going to do that because it would be really exceedingly bad business, although I saw Countryside do it before.
countrywide.
Countrywide
Yeah.
did in the past.
We see that more common like on second mortgages. So if someone has a home equity line of credit, even if there's nothing on it, and they're like, oh hey, I want to leave it open, but I just want to refinance, they don't get that it would take extra time to do a subordination with that lender, because otherwise they'd move into first.
Right.
And that lender's, they're not going to lend you the same terms on a first versus a second.
So what's in it for the IRS to do this?
Yeah, that's a good question. And why does it go away after 10 years? We didn't answer that yet.
Well, it goes away after 10 years because Congress put a statute in that says that it goes away after 10 years, because I guess Congress didn't want this to be a lifetime sentence. Back before the 80s, the statute of limitations time was only 6 years.
Wow, really? So they made it longer?
So they made it longer. They went from 6 to 10. It's interesting that most people don't know there's any statute of limitations
No.
at all, and so they think that if they have tax debt, it's just a lifetime sentence, sort of like student loans.
Yeah.
And, which
Well,
are
that
not-
might be another story in itself.
which is not categorically necessarily a lifetime sentence, but pretty close. So anyway, there's a 10-year statute of limitations. Here's what's in it for the IRS. Usually, they're going to want some crumbs. They're not doing this just out of the goodness of their heart.
They
They're
want
usually
some
going to want $500 or $1,000 out of the deal.
Is that their fee to subordinate it?
Yeah, it's kind of just like the
Wow.
tax. It's just kind of like the tax to get it done.
We're going to give you a subordination tax.
Yeah, so they're going to take a little bit out of the closing. It usually doesn't hurt too hard, and that's what they do. So if you want to know more about lien subordinations, you can go check out IRS publication 784. There's now a form number for lien subordinations. I don't know it off the top of my head, but the publication 784 will tell you all about it. And it used to be harder. It used to be really hard. Back when I got $500 for that one deal that I told you about, it was very difficult. It is
But you know what?
quite
That was
a bit
totally
easier.
a learning experience.
Yeah.
I'm sure you took so many things away from that.
I did. I learned how to charge for those cases too.
Other than that, but you learned, I'm sure, a lot in that process.
Well, that's why they call it the practice of law or the practice of medicine, or that's why they call it practice.
Practicing on someone.
Well, it
Pretty
sounds
much.
bad, but you learn from experience. So I don't know about you, but I don't want to go to a doctor that is a year out of med school. I mean, he might have learned all the latest things and all the technological updates.
Hence-
I think I'd rather go with the guy with 20, 30, 40 years
Hence,
experience.
real estate practice.
Yeah,
For your friend that just got their license.
And I can tell you in law, what happens is, in the course of your career, there's going to be lots of hurdles and obstacles and things that just go wrong. They're not necessarily the lawyer's fault. It's just the facts of the case, or if a case is ongoing, like let's say you're in a criminal matter and you had a witness that just testifies completely differently than you were expecting. You just have to go with the flow. You just have to learn how to
Adjust.
quickly adjust, and nobody can even tell that you're adjusting, because you can't, smack your forehead and go, oh, geez, I can't believe that just happened. You have to just stand there like, oh, I knew that was going to happen all along, because it's all theater,
It might sound funny, but in our business we call that turbulence. And so anytime I have a consultation with a new buyer or seller, I literally show them this list, and I joke about it and say, this is our short list of 88 types of turbulence, and this is things that can go wrong when you buy, sell, or borrow money. And they kind of look at me like, you're telling me all these things that can go wrong? Yeah, because if any of these things happen, I still know how to fly your plane. We'll be able to get past this turbulence, but it's there.
I love that. You've never shared that with me before.
No, I have
I'm writing
not.
it down.
I'll
That is
send it to you
beautiful.
so you can see it.
Because that's in fact what happens.
But
I mean,
it's
there's all kinds
literally
of
like
things
I
that
can make it
happen.
188.
And you can even have client caused turbulence.
Oh yes, it's in there. It's on the list. You look at it. I'll send it to you.
If your client, it's similar to my client, if your client doesn't provide you documentation and isn't responsive and just kind of ignores you and blows you off, that's going to cause severe turbulence.
We did a show, I think, on that once. I had a guest that didn't come in, and I had to create a show on the fly for Tampa Home Talk, and then I think we did that based on turbulence.
And he had a picture taken at McMurdo in Antarctica of the sunglasses, and so the pressure's on.
You're going to have to make a trip to Antarctica just so you can find a guy that didn't pay his taxes.
Exactly.
All right, this is the IRS Solution Attorney Show. We'll be back in a minute.
To the IRS Solution Attorney Show. I'm the IRS Solution Attorney, Darrin Mish.
He's either getting bored or he's got to think about it. I'm your co-host, Katrina Maple. Welcome back.
I learned a lesson today from Pat. I was telling him he sounded a little low energy today, and he says, no, I am not low energy. I am just mixing it up. And so I'm, in fact, trying to mix it up just a little bit.
What, are you saving your energy for something else?
Yeah, tequila.
Yeah, exactly. Exactly.
All right, so we don't have a whole lot of time, so let's talk about a certificate of discharge from federal tax lien and when that comes up.
Yes, and we had a question from our listener that we have to get to.
Okay, so I'm going to go real fast. So the certificate of discharge of property from federal tax lien happens when you just want to sell, but when you sell, there's not enough proceeds to full pay the tax lien. Does that make sense?
Yes.
So let's say you're going to sell and you're only going to get $25,000 from the sale, and the tax lien is $50,000. So what happens? Well, you go to publication 783, IRS publication 783, and you're going to look at the certificate of discharge from federal tax lien procedures. And basically what's going to happen is the IRS is going to get involved in your closing. They're going to make sure that they're being treated fairly, that they're going to get the 25 grand, and you're going to be able to sell your house. Now, you're not going to get any proceeds, but there are people that don't mind.
Wipe out your tax debt?
No, it's not going to wipe out your tax debt, but it's going to go, if you owed 50 and they get 25 from the sale, now you're only going to owe 25. So there are people where that's the right thing to do.
I think I want to wait and see if I can settle that or something.
In fact, Sarah and I are trying to work with this woman who really, she really just needs to sell the house because she can't refi, the debt ratio is all messed up, and the lien's too much. And really what she needs to do is just sell the house and get out from under it. I don't know if she's going to do that. That's a very emotional thing to do.
It is, but sometimes it's better just to hit that reset button.
Sometimes it's better to just get out of a bad situation than just stay in the bad situation too long. So let's get to that question, okay?
Yep, so the question that we had from one of our listeners, thank you, Carl, very good question, right on time for the show. He says, I have a friend who just had a tax lien filed against his rental property. Will he still be able to rent it out? That's a good question.
Absolutely. It's not going to make any difference at all whatsoever. The lien is not going to prevent him from renting the property or using the property in any way that he wants. Now, theoretically, if the IRS wanted to seize that property, they could. It would be easier than seizing the primary residence. It's easier to seize the rental because they don't have to go through the judicial proceedings. They can just go ahead and do it. And there's ways to appeal and whatnot. It's not super. The IRS was really interested in taking your stuff, and they did it all the time. They did it punitively. They did it punitively. They did it to teach you a lesson. But after 1998, there was a bunch of reforms that went into place, and now punitive seizures are against the law. So they can't just seize something if it's uneconomical. So
you know what's interesting, talking about that, like with the IRS kind of like intercepting that rent money, we saw this a lot back in the day when the housing market was collapsing, and literally if you took that to court, because we've seen it happen, they would say, well, your contract with your bank is totally different than your landlord-tenant contract. So basically a homeowner could not be paying their mortgage, yet still be collecting rent, and the tenant couldn't do anything about it. Well, the banks have since put a little clause in the mortgage that says if you're in default, they can swoop in and take those rent payments.
And the IRS could levy the rent payments. It's different from the lien process.
Sweep the bank
The
account?
IRS could either levy the bank account, or they could issue a levy notice to the renter that says, hey, don't pay landlord anymore, pay us. Now, what happens in that situation? Typically, when you have a levy like that, what happens? Well, nobody pays anybody. That's what really happens, is the renter goes, woohoo, free rent, and they don't pay the landlord. Landlord thinks that the tenant's paying the government. Government doesn't get paid. Government's like, oh, we're so big, they don't even notice.
Right.
And
then you got to evict this tenant out of your property.
yeah, it's just a nightmare.
Not fun. That train came in hard and fast today.
This is the segment of the show called the IRS Train Wreck of the Week. This is the segment where we talk about somebody who came into the office and they had just a big problem, and we ended up working with them, and it had a happy ending. This case is pretty right on time for today. A lady came in with her fiance, and they were wanting to get married. And I was, as they're telling me that, I'm like, that's wonderful. I'm not really sure why you're here, but God bless. Go get married. It's great.
Gotta be something tax related in the story.
And what happened is she had some outstanding tax liabilities, and it was a lot of money. It was $379,324. $379,324.
Was she a younger girl or no?
She was middle aged.
Okay.
And been married a few times before. But fiance was like really not interested in getting married until the tax situation was resolved. And so she's telling me the story, and one of the things that's going through my head is, wow, I mean, these are older tax debts. The statute of limitations has got to be getting close. And so what we did is we went ahead and we got her transcripts. We got a power of attorney, we got her transcripts, and we're able to identify that the statutes of limitations were going to expire. I think it was in like 6 or 8 months, right? So what did we do? Well, she was already in uncollectible status with the IRS, which meant the IRS wasn't going to butt her. And so we just simply waited until that time elapsed. And then we reached out to the IRS. We asked the IRS to release all the tax liens, which they did because they have to by law, right? And I got the job of telling them that they can get married.
Yeah.
And so she ended up walking away from $379,324. There's people that are listening who are thinking, wow, that's really not fair.
Right.
Right? Well, let me tell you.
That a lot.
Let me tell you what was going on here. The IRS prepared those returns for her. And so this was an artificially, they were substitute for
So
returns.
she didn't file. I was going to ask you what kind of tax.
And so this was just like a completely blown out of proportion, not real number that had then doubled over the years with interest and penalties. And so, okay, people can think it's not fair, but it wasn't fair what the IRS had done either.
So she just didn't file.
So she didn't
Talk
file.
about this
And I forgot this part of the story. We had to catch her up. We had to file the last 6 years of returns. She was pretty low income at that point. She had refunds coming back. The refunds went back to
Oh my gosh, that's awesome.
$379,000. And so now she's completely straight. All she has to do going forward is file a return with her W-2, with her new husband, and they can live happily ever after.
Was she self-employed at that time, or?
Way back when,
Okay.
yeah, she was self-employed, and so what they did is they took the gross amount of the 1099s and they just multiplied it by the tax rate, and it equaled a big fat number, and then a bunch of interest and penalties, and it just got out of hand. And she did what a lot of people do, is she just went into like ostrich mode. She just stuck her head in the sand, and in this case, to her credit, it worked out pretty good for her. But think about how much of her life she gave up. I mean, she had her head in the sand for like 15 years.
Yeah, at least get advice so you know where you stand with it, and you can put together some type of a plan, or you have an idea what at least is coming or not coming.
Yeah, and I don't want to give the impression that every case turns out just wonderful. Not every case does. And that's just the God's honest truth. Is that
But
they
that's
don't.
our train wreck.
But that is, in fact, a true story, and it really did happen. And more cases work out good than bad.
All right, well, this is the IRS Solution Attorney Show. If you or someone you know in any state has a tax issue, especially a big tax issue, Darrin is your guy, and you can get him at 888-GET-MISH.
888-438-6474. Visit the website at getirshelp.com.
They'll thank you that you made the biggest problem of their life go away after you introduced to Darrin. Thanks for listening this week. We're glad to have you.